Okay, everyone. All right. We are in Chapter 6. We are looking at problem 6-1B to review. So hopefully you tried this on your own and you're just looking at this to make sure you completed it correctly, or that's the way you should be doing it. So on page 251, we have here, excuse me 1 second. Sorry about that. Forgot to get my glasses. Have everything ready but that. Okay, so on page 251, we have Ming Company uses a perpetual inventory system. It entered into the following purchase and sales transactions for April. For specific identification, the April 9th sale consists of 8 units from beginning inventory and 27 units from the April 6th purchase. And the April 30th sale consists of 12 units from beginning inventory and 3 from the April 6th and 10 from the April 25th purchase. So compute cost of goods sold, compute cost of goods available for sale and the number of units available for sale. It's the first thing we're going to do. Then we're going to compute the number of units in ending inventory. And then we're going to compute the costs assigned to ending inventory under 4 different inventory costing methods or inventory removal methods. And then we're going to compute the gross profit under each of those 4 costing methods. So the first item is compute cost of goods available for sale. So the total cost of everything that could have been sold and how many units could have been sold. So the way we do that is we take, where did we begin the month at? Beginning inventory, there were 20 units. I hate saying units, so let's say 20 coffee cups. This company sells coffee cups. 20 coffee cups, they cost $3,000 each. That's an expensive coffee cup, right? So the total cost of beginning inventory is $60,000. The April 6th purchase, they purchased 30 more coffee cups. These now cost the company $3,500 for a total cost of $105,000. The April 17th purchase, they purchased 5 more coffee cups that cost now $4,500. So their cost is increasing, what their supplier is charging them. Their new cost is $22,500, or I should say the total cost of that purchase. And then the April 25th purchase, they bought 10 coffee cups that cost now $4,800 each, for a total cost in that purchase $48,000. So how many units could they have sold in total during the month of April? Well, the 20 in beginning inventory, plus the 30 from the April 6th purchase, plus the 5 from the April 17th, plus the 10 from the April 25th, or 65 coffee cups, units. How much did those coffee cups or goods cost in total? Well, the beginning inventory total cost was 60. April 6th purchase was a total cost of 105. April 17th, 22,500, and then April 25th, 48,000. So you add those all together, 235,500. So that's how we determine units available and how much all of those items cost. Now what's left? Well, it says on April 9th, they sold 35 units, and on April 30th, they sold 25. So they sold a total of 60 of those coffee cups during the month of the 65. So at the end of the month, there's 5 coffee cups left. So it doesn't matter which method you use to remove the inventory, you're always going to account for 60 coffee cups that were sold and 5 that are left. So you need to keep that in mind. Now in requirement 3, it says now assume that when the company sells a coffee cup, they remove the first ones in inventory first. First in, first out. So let's take a look. This is a perpetual inventory record. We've seen it before. We have 3 main columns. Well, really 4. Date, First column is where we record all purchases. So you still do journal entries for your purchases like you did in Chapter 5, but we also keep a separate record of the detail of the purchase in the perpetual inventory record. Then anytime goods are sold, we need to calculate how much those goods cost. We know how much we charge the customer, but how much should we take them out of inventory at? And then after any purchase or sale, we need to determine a new inventory balance. So start with April 1st. In the beginning of April, there's 20 units, 20 coffee cups that cost $3,000 each for $60,000. The next transaction occurs on April 6th. Remember, perpetual inventory, we're keeping track as we go, as it occurs. 30 more coffee cups are purchased, so we'll populate the information in that column. They cost $3,500 each for a total cost of $105,000. So after this purchase, what's the inventory balance? 20 coffee cups that cost $3,000, those really old ones from the beginning of the month, and then the 30 we just bought that cost $3,500 each. If we multiply those out and add them together, the inventory balance is $165,000. On April 9th, we sell 35 coffee cups. We charge the customer $12,000 each. So 35 times 12,000, $420,000 is the revenue related to that sale. So we would credit sales revenue and maybe debit cash or accounts receivable, depending on if they paid or not. That's not what this record does. This record figures out how much to do in that second part of the journal entry. How much do we debit cost of goods sold and credit inventory for? And under first in, first out, since we don't know exactly which ones were sold under this method, we assume the first ones in inventory are sold first. So 20 of the ones we sold cost us $3,000. The other 15 we sold are from the purchase that cost us $3,500 each. So we remove those really old ones. We assume those are sold first. So the total amount that would be debited to cost of goods sold, credit to inventory, $112,500. What's left in inventory after this sale? Well, the first 20 are gone up here, or right there. I don't know if you can see my cursor or not, so I'm just those are gone. We sold them. And 15 of these are gone. So there's only 15 left at $3,500. That's what they cost. On the 17th, we purchased 5 more at $4,500. So we add those to inventory. So now you could see we have the 15 that cost $3,500, and we just added 5 more that cost $4,500 each. The next transaction happens on April 25th, and that's also a purchase. So we'll show that we bought 10 more coffee cups. These cost now $4,800 each, total of $48,000, and we'll add them to our inventory balance. So we'd say what was there before, these 15 and those 5, so they're still here. And now we just added 10 more for a total inventory cost of $123,000. On April 30th, they sell 25 coffee cups. Now they charge their customer $14,000 for a total revenue of $350,000. So debit cash, credit sales revenue, $350,000. How much should we debit cost of goods sold and credit inventory on the day of this sale? Well, first items in are the first ones sold. So we have to remove 25 coffee cups. So these first 15 are removed first. Then we say, okay, what's next? These 5 at $4,500. So we're removing the oldest inventory, and then 5 more we need to remove, 5 of the ones that cost us $4,800. So if you multiply those out, add them up, $99,000. What's left after this sale? Well, there's only 5 of the ones that cost $4,800 left. So the ending inventory balance on April 30th would be $24,000. And it goes and flows through true to what we set up here. We add 65 we could have sold. We sold 60 of them. There's 5 left. Under FIFO, these 5 cost $4,800 each. Under FIFO, our total cost of goods sold is $211,500. So that's one way we could have removed the coffee cups as we sold them. Let's look at LIFO. LIFO takes the opposite approach. It says the newest items in inventory are considered to have been sold first when there's a sale. So we do a perpetual inventory record just like we did for FIFO. We'll start with our beginning balance, 20 coffee cups. They cost $3,000 each. When we purchase 30 more, just like we did for FIFO, we have to layer our inventory from oldest purchases to newest. So we're going to add 30 more that cost $3,500 each. So now our inventory balance is the 20 that we had before the purchase and these 30 we just bought at their respective costs. On April 9th, we sell 35 coffee cups. We charge our customer $12,000 each. We still have revenue, $420,000, just like we did under FIFO. But how much do we debit cost of goods sold and credit inventory for? Well, under LIFO, the assumption is the last items purchased, last in, are the first ones out. So the newest items are assumed to be sold first. And if you're going, how do you know that? We don't, we're pretending, okay? And it's okay to pretend, just as long as we consistently pretend. It's called assumptions. We just assume that's how they're being sold. So of the 35 that were sold, the first 30 are assumed to have cost the company $3,500 each, and the remaining 5, $3,000. So under LIFO, cost of goods sold would be $120,000. What's left? 15 of the coffee cups that cost $3,000, because these 30 were removed and 5 of these were removed in that sale. Just like before, when we buy more goods, we're going to add them to our existing inventory. So there we are buying 5 more coffee cups at $4,500 each. So now we have 15 that cost $3,000 and 5 that cost $4,500. Then on the 25th, we'll buy 10 more that cost $4,800 each. After this purchase, we have the 15 that cost $3,000, the 5 that cost $4,500, and now 10 more that cost $4,800 each. So we layer them, oldest to newest. The last transaction is our April 30th sale. Again, when we sell 25, we charge our customer $14,000. So the sales revenue related to this sale is $350,000. But under LIFO, we would calculate cost of goods sold by saying, what are the newest coffee cups? Well, those are the first ones we assume to have been sold first. So remove the newest first. So these 10 are removed. And there they are right here. Now we sold 25. So those are gone. So now the next 5 that cost $4,500 in inventory, they're assumed to have been sold. So there we've removed 15 so far. We need to remove 10 more. So we'll remove 10 of the ones that cost $3,000. So under LIFO, the cost of goods sold for this sale would be $100,500, or a total $220,500. What's left? Well, the 5 that cost $3,000. So ending inventory would be $15,000. Remember, the way you remove your inventory, the costing assumption you use does not have to mirror how it physically is sold. I think that's where people get caught up in doing these and they're like, wait, how can we do that? I remember I did. I'd be like, why am I doing it that way? Because we're pretending. We do that sometimes in accounting. Okay, final, or I should, it's not the final one. Weighted average perpetual. So now we're going to use this inventory method, which is a little different than LIFO and FIFO. Here, remember, after we remove inventory at its newest average cost. but we must change the average cost per unit each time we buy more inventory. So let's take a look. We start the beginning of the month with 20 coffee cups that cost an average of $3,000 each. When we buy 30 more coffee cups, they cost $3,500 each, or a total of $105,000. Now we don't go 3,000 plus 3,500 divided by 2. No, that's not how we calculate weighted average cost. What we do is we say, okay, what's the total cost of all the inventory we have after this purchase? Well, before the purchase we had 60,000, 20 at 60,000. We just added 30 more that cost 105. So after this purchase, we have 50 coffee cups that cost 165,000. Divide the 165,000 by the 50 coffee cups. So you take the total cost divided by the total quantity. And your new average cost per coffee cup, $3,300. So that's how that average cost is determined. So then on April 9th, when we sell 35 coffee cups, charging our customers $12,000 each, our revenue is still $420,000 under this method. Yeah, because our sale price has not changed. The way we remove our inventory does. So the amount that would be cost of goods sold would be different under each method. Here we remove the 35 at the last average cost of $3,300. Just multiply them together. So cost of goods sold would be $115,500. What's left? Well, we have 50, we sold 35, so there's 15 left at $3,300 average cost. Total cost, when you multiply those out, $49,500. On April 17th, we buy 5 more at $4,500 each. Now the total cost of all of our inventory, so before the purchase, it cost $49,500. We just added $22,500. So the total cost of all of our inventory is $72,000. What's the total quantity? We had 15 before. We just bought 5 more, so 20. So 72,000 divided by 20. $3,600 is your new average cost. Now, if we sold any between the April 17th and the April 25th purchase, we would have removed them at $3,600. But we didn't. We bought more. We bought 10 more that cost $4,800 each, or $48,000 in total. So now, what's the total cost of all of our inventory after this purchase? Well, it was $72,000 before the purchase, and we just added another $48,000. So total cost is $120,000. How many units do we have? 15, 20, 30. So 120,000 divided by total units of 30, $4,000 is the new average cost per unit. So on the April 30th sale, we sell 25 coffee cups. We charge our customers $14,000. Cost of the inventory would be 25 times the last average cost of $4,000, $100,000. So under the weighted average method, cost of goods sold would total $215,500 for these two sales. What's left in inventory? 5 coffee cups that have an average cost of $4,000 each, giving us ending inventory balance of $20,000. 3 different ways to remove inventory, 3 different dollar amounts calculated. And we'll be looking at that again in part 4. 3D. Now in this one, we know exactly how much the items cost that we sold. Pretty cool. So all we would do is say, okay, we sold, tells us up in the top, in the first sale. On the April 9th sale, 8 units from beginning inventory. So 8 units that cost us $3,000 were sold, and 27 units that cost us $3,500 were sold. Now they don't calculate them separately because they go on to say, oh, in that last sale, 12 units from beginning inventory were sold. So 8 on the first sale on April 9th, 12 on the April 30th. So a total of 20 units were sold that cost $30 each. And on the second sale, 3 units from the April 6th purchase were sold. But on the April 9th, 27 were sold. So 30 of the ones that cost $3,500 were sold during the month. And then 10 units of the ones that cost $4,800 were also sold on the 30th. So the total cost of goods sold, you multiply those out, add them together, $213,000. So that's what specific identification is. You know how much those items that you just sold cost you. Not many companies are able to do that. So those are our 4 different ways of removing inventory. The very final item is now compute gross profit earned by the company for each of the 4 costing methods. Now, if you've been following along and listening to what I'm saying here, first of all, we need to know what gross profit is. Sales minus cost of goods sold. And it's generally net sales minus cost of goods sold. What is net sales for this month of April? Well, they tell us on April 9th, they sold 35 units, charging the customer $12,000. So, turn my printing off. No print. Okay. The first sale was a $420,000 revenue, sales revenue. The second sale, they sold 25, charging the customer $14,000 each. Multiply those out, you should get $350,000. Bear with me a second. $350,000 plus $420,000. Total revenue or sales, $770,000. And that's for each method. They don't have there, well, if you're using FIFO, here's how much we're going to sell it to the customer. If you're using LIFO, no. The sale price is the sale price. It's based on how much you pay for stuff, not the amount you're removing it at. So it doesn't matter FIFO, LIFO, average cost, or specific identification. Your sales revenue is $770,000. What will differ is how much you expense in the cost of goods sold, because we figured out the cost of goods sold under different assumptions depending on what we used. For instance, I'm going to scroll back up here. Under FIFO, your cost of goods sold for the 2 sales is $211,500. So $211,500. Subtract $770,000, what you charged the customers for the inventory, what the inventory cost you using FIFO of the items you sold, $211,500. Gross profit, the difference, $558,500. Do the same thing with LIFO. Go back up here. Here's our LIFO. $225,000 is the amount of cost of goods sold. So $770 minus $225,000, gross profit $549,500. Weighted average, $215,500. Subtract that from your sales. Gross profit is $554,500 under that method of removing inventory. So all these are acceptable. You just got to pick which one you want to use. And specific identification is probably the most accurate. Sales minus the cost, and that is the actual cost of the goods that were sold, gives you a gross profit of $557,000. So which one do you use? Well, it's up to you. Most companies pick it based on their financial objective. So if the company's financial objective is to use the method that will show the highest amount of profit, they're obviously going to use FIFO. And the reason it shows the highest amount of profit is because the amounts in cost of goods sold are the oldest cost. You're removing inventory or debiting it to cost of goods sold, oldest to newest, first in, first out. The complete opposite happens to LIFO. So if you're trying to save on income tax, you want the lowest profit, you want to use LIFO because it gives you normally the highest amount of expense, $225,000 here. But it also causes your profit to be at the lowest point, $549,500. Weighted average is usually always in the middle somewhere. So it's a little bit of each, right? And it's kind of if you have a mixed financial objective. You don't need the highest net income, and you don't need the lowest in taxes. And specific identification is just that. There is no financial objective behind it. It's just, I want to remove it. If I can remove my inventory, it gives me the most accurate picture of my gross profit. I charged my customers $770,000. The items I actually sold did cost me $213,000. So my actual profit is $557,000. So it all depends on your financial objective. Okay, so that's a big chunk of our chapter there, isn't it? 6-1B. Go to 6-5B now, which is going to show us a nice activity on lower of cost or market. So I'm just going to scroll on over there. All right, here it is. A physical inventory of Office Necessities Company taken at December 31st reveals the following. Compute the lower of cost or market for the inventory applied separately to each item. So what we're doing here is first we're saying how many desks are there? So how many units of each? What's the cost per unit? What's the market per unit? Remember, market isn't what they're selling it for. Market is what it would cost them to replace on December 31st if they had to buy that desk again and put it into inventory. So we're going to multiply the units by the cost to get the total cost for each item, the units by the market to get the market value for each item. And that's what you do for the chairs also, and the mats and the bookshelves. Now, the magic of lower of cost or market says, now compare which one's lower, total cost or total market. Well, total cost is. So that is the amount that should be in your ending inventory. Do the same with your chairs. Chairs cost is lower than market, so that's the amount of the value, that's the debit that should be in ending inventory. How about the mats? Well, the cost is actually higher than the market. So the amount that should be in ending inventory, $29,541. And the bookshelves, same deal, market's lower. So if they had to replace those bookshelves, they would pay less than they actually did when they first bought them. That happens. Go through the same process for the filing cabinets. Here, your total cost, $92.34 for a 2-drawer, $79.80 for market. Market is the amount that should be in inventory. Same with the 4 drawers, market's lower. The lateral, though, the cost is lower. Now remember, what's normally in inventory? The cost, right? Office equipment, our projectors, cost was lower, so that's the value that should be in ending inventory. In the copiers, though, the market value is lower, so that should be the value in ending inventory. And then our phones, same deal. So the actual amount of our inventory balance right now in our T account is the cost. $610,126, because when we bought these items, that's what we debited the inventory account for. But according to our analysis at the end of the year, our cost should be $580,054. That's what the balance should be, because some of the market values were lower than what we originally paid for them. So what do we do to correct this? Well, we have to make an adjustment. So we take the difference between where our account is at now, $610,126, what it needs to be at, $580,054. And we decrease our inventory account $30,072 because it should be at a lower amount. The difference, that $30,072, is debited to cost of goods sold and expensed. Okay, so that's where we put that. It's almost like it's a loss on our inventory, but instead of having a separate account called debiting loss on inventory, we just debit cost of goods sold. Okay, so that's a great exercise on lower of cost or market value. Okay, so those are our review problems for Chapter 6. Please post your questions to the discussion board.